Financial Analysis from A to Z Episode 1. Let's learn to read the two documents that tell the whole financial health of a business. The balance sheet and the income statement. A business rests on two documents. The balance sheet, its picture of net worth. The income statement, the film of its activity. Across this series we analyze one real company in structure, DistribPlus, £48 million of turnover. On the agenda. The balance sheet as a snapshot. Assets and the way they are funded. The income statement as the film of the financial year. The big confusion between stock and flow. And our 5-step reading method. Chapter 1. The balance sheet, the picture of net worth, at one precise date. The balance sheet captures the financial position at a point in time, the reporting date. It is a stock, the accumulation of every financial decision taken since the company was founded. Assets answer one question. What does the business own? Fixed assets, what lasts, machinery and property. Current assets, what circulates, stock, trade receivables and cash at bank. The other side answers how the business funded all of this. Equity, the shareholders' funds and the retained profit. And liabilities, bank loans, trade payables, tax and other amounts owed to third parties. The golden rule of the balance sheet. Total assets always equal equity plus liabilities. What the business owns is always exactly equal to the way it has been funded. This balance is required by the Companies Act. Here is our through line at year end. DistribPlus, £48 million of turnover, 15 stores, £1,200,000 of net profit and £650,000 of cash at bank. These figures follow us through the whole series. The asset mix of a retailer. Almost 2/3 in fixed assets, stores, and warehouses. 15% stock, 13% trade receivables, and 7% cash. Every sector has its own signature. You read the balance sheet first by big blocks. The top, the long-term, fixed assets against equity and long-term debt. The bottom, the short cycle, stock, receivables, trade payables, and cash at bank. An essential nuance. Assets are shown at net book value, the cost less accumulated depreciation. Depreciation records the wearing out of an asset over time. It reduces profit, but without any cash leaving the business. On the funding side, one item deserves attention: equity. It belongs to the shareholders, share capital, reserves, and retained profit. It need not be repaid. It is the cushion that absorbs losses and reassures both banks and suppliers. Here is the DistribPlus balance sheet in big blocks. On assets, nearly 15 million in fixed assets, the stores. Against them, 9 million of equity and 6 million of long-term debt. In total, assets equal equity plus liabilities. Chapter 2. The income statement, the film of activity across the whole financial year. The income statement covers a period, the whole financial year. It is a flow that measures performance. Its logic fits in one sentence. Income less expenses gives the profit for the year. The income statement reads on 3 levels. Operating profit, the core trade. The finance result, interest on loans and on investments. And after tax, the profit for the year, what belongs to the shareholders. The income statement sets two families against each other. Income, which enriches the business, sales, other operating income, grants. Expenses, which reduce it, purchases, staff costs, depreciation, tax. The difference over the year is the profit. Let's read DistribPlus over 2 years. Operating profit falls from £1,560 to £1,220,000. The finance result worsens. And net profit drops by a third. 3 levels, 3 signals. 1 measure bridges to cash, the cash the operations generate. It is the profit plus the non-cash charges such as depreciation. It approaches the liquidity the trade really throws off, enough to invest and to repay debt. The real message at DistribPlus. Net profit falls, but the cause sits in operations, not in one-offs. Running costs rose faster than sales. It is a structural problem of the trade, not a one-off accident. Let's translate the performance. The net profit of DistribPlus falls from £1,850 to £1,200,000, a drop of 35% in 1 year. And the finance result worsens by a further £85,000. Chapter 3. The costliest confusion in financial analysis: net profit is not cash. The classic confusion. The owner thinks a profit means money in the bank. The reality: a credit sale is income, not cash received. Depreciation cuts profit with no cash leaving. You can be profitable yet cash poor. The paradox of our through line. DistribPlus reports 1.2 million net profit, yet its cash is shrinking. Why? Stock has swollen, customer payment terms have stretched. The profit is locked in the operating cycle, not available in the bank. For confusions to avoid. Profit equals money in the bank, false, it can be locked up. Sales equal cash received, false, a credit sale is still owed. Depreciation equals a spend, false, it is a calculated charge with no cash. The discipline of cash. Track net cash as closely as profit. Reconcile profit and cash movement every year. Watch stock and receivables, where the cash sleeps. And remember, an uncollected profit stays a risk, not a safety net. Chapter 4. Reading the accounts in the right order, a 5-step method. Our reading method. We start with the notes, the manual to the figures. Then the balance sheet, for structure. The income statement, for performance. We isolate the recurring profit, excluding one-offs. And we finish with cash. The document people always skip, the notes. They complete and explain the balance sheet and income statement, accounting policies. Useful lives, off-balance sheet commitments, events after the year end. They form one indivisible whole. One principle governs every reading: prudence. A probable loss is provided for as soon as it is known. But a merely hoped for gain is never recognized. This is required by the standard, FRS 102. The reflex that saves you: read the trend, not the level. A single figure says nothing. A margin of 3% can be excellent or alarming. You always read several years and compare with the sector. The right reflexes. Always 2 years side by side, the trend beats the level. Read the notes before the tables. Separate the recurring from the one-off. And reconcile profit and cash, never one without the other. Chapter 5. The beginner mistakes, and the full pathway on ActioFin. The 3 beginner mistakes. Confusing profit and cash: a profit can hide an empty account. Reading 1 year only, when the trend is what speaks. And ignoring the notes, which often change the entire reading. All of ActioFin for financial analysis. The complete, free course, chaptered like this series. The ratio calculator from your balance sheet. The workshop to analyze a real set of accounts. and solver for your questions with sources. 2 levels on ActioFin. The free one, to learn, with the chaptered courses and the explained calculators. And to go further, Solver, which answers with sources across 15 countries, and the workshop for a guided financial diagnosis. First episode done. You can now read a balance sheet and an income statement, and no longer confuse profit with cash. Find the free course and the ratio calculator on ActioFin. In episode 2 we go down the margin cascade, from revenue to net profit. Put these foundations to work on ActioFin.com. Subscribe, and see you soon.